Welcome to another wonderful White Coat Investor webinar. I'm here with Adham. He is the founder and CEO of Frec. Frec, you may know, is the direct indexing guys. We've done a webinar before here in the Facebook group, and we have had a lot of interest, actually. People are interested in direct indexing, especially now that it can be found at very low cost, which was, a big problem early on with direct indexing, where people wondered if it was worth the money. Well, now that the cost has gotten so low, I think that question is mostly not as big of a deal anymore. So listen carefully, especially if you're sick of paying high taxes, or if you have a lot of uses for some more capital losses from your portfolio. This is a presentation you're going to be very interested in. Mo, thanks for doing this webinar with us, and let me turn some time over to you.
Awesome. No, thank you for having me. I had a great time in the first one, and I'm excited to be back here again. Just as a quick intro, we are building a direct indexing platform, purpose-built for the self-managed investor. We get some customers who have advisors, but the vast majority of our customers are self-managed. They're the classic, sort of like, I would say, I'd call them like maybe a bogglehead, believe in sort of like simplicity of a portfolio. And when we started building this company, we realized, there's nothing that exists for this type of person. In fact, I was one of those people. I was pitched direct indexing by an advisor. And then when I did the math and added the advisor fees and the direct indexing fees, nothing kind of made sense. And I went in and decided to build a company out of this. We launched the product 2 years ago now. And we just as a quick snapshot of our progress, it took us about 12 months, the first year, to go from 0 to 100 million. And in our second year, we went from 100 million, now crossing 500 million in assets. And a lot of sort of like doctors actually use Frec, as well as a lot of tech employees, a lot of people in finance, a lot of lawyers, professionals, for the most part, that are comfortable managing their own money. We raised $31 million in venture capital, very well funded. Most companies maybe plan for 2 years of runway. We have a much more extended runway because we know people are trusting us with their assets. And sort of like our last round, actually, we closed just last week from the date of this recording. We're growing also quite fast, doing about 50% quarter over quarter growth over the past year. And delighted to also kind of share that a lot of it is organic, a lot of it's through communities like the White Coat Investor and referrals, where people kind of talk to their friends or colleagues or coworkers about their experience on Frec. So today, I'm going to kind of cover the basics of direct indexing. Obviously, feel free to interrupt me, Jim, at any point in time and to ask questions. But I will talk about direct indexing. I want to introduce this concept of a long-short direct indexing because it's a very popular area that is getting a lot of coverage on sort of like financial kind of news. Talk about pricing, and what pricing doesn't make sense, about pricing it doesn't make sense, all the different use cases, FAQs, the features that we offer besides just direct indexing on Frec, and some FAQs. Cool. Okay, so I'll start with the basics. What is direct indexing? You can think of direct indexing as simply a tax deferral strategy, where you sort of like kick the can down the road on paying the taxes that are owed. The taxes are eventually owed, for sure. But the way it works is it's in a way like a replacement for a classic ETF, right? So let's take SPY for instance. SPY is an ETF that tracks the S&P 500 index by Standard & Poor's. So we go and license the same exact index from Standard & Poor's, and we basically go in and buy the individual stocks within that index, right? The same stocks that SPY also buys, right? So we buy NVIDIA at 7%, Microsoft, Google, we buy all the, the Exxon, all the, all the companies that are represented in this index. And then we kind of monitor these stocks every single day. And we see that if a stock loses value or dips below its cost basis, so say we bought a stock for $100, now it's trading at like 80 or 70, we flag it and we say, well, we could sell this stock, right, and buy a replacement stock instead and capture that loss, in this case, $100 loss, right? So we capture the capital loss, right? Buy a replacement stock in the meantime, And when the wash sale window is like opened up again, we go back and buy that original stock that we sold, right? So you do this constantly over time for thousands of positions in your portfolio, and you accumulate these capital losses over time, right? And these capital losses at the end can be used to offset a tax bill, right? You get a 1099-B form in your inbox. You hand it to your TurboTax, your tax accountant, or if you're doing your taxes yourself, you use that to offset any other sources of capital gains in your portfolio, right? And it sort of like helped demystify the way the product looks and the way the experience is like. We say it's as easy as an ETF. It's no different from buying an ETF. You press a couple of buttons. You say, I want to invest this much money into this index. We have 16 indices on Frec that we can talk about in a bit. And then you essentially, get to, invest in your favorite index, right? Track it closely while harvesting losses, right? So this is what the experience looks like. You have on the top left, you see sort of like, your portfolio relative to a SPY. You see your, sort of like the harvested losses to date. I want to go back to the slide for a second. You see the excess return or the relative return, right? Basically, your tracking error. In this case, it's practically 0%. Your tax losses harvested. And so in this particular example, you've tracked the index really, really closely, and you've also harvested $4,500 in capital losses that you can use against capital gains, right? And you can get to see as well on the right-hand side all the positions and how far they are from their target rates. Okay, so that's essentially what it looks like. It's no different than buying an ETF from an experience point of view. From a complexity, you just choose the index, put in the money, and you can set up recurring deposits. You can withdraw money, of course, as well. But the question becomes, well, how much can I harvest in losses, right? Is it going to be meaningful for me? Do I need to do this, or am I okay? Maybe not changing my investment vehicles. So let's talk about research coming out of Vanguard, right? And our research also kind of corroborates that plus or minus a few percentage points. So you can expect to harvest approximately 40% of your investment in losses, right? If you invested $1 million, then you can expect to harvest approximately 400K in losses over a period of 10 years, right? And it depends on the decade, of course. Like in these decades where a lot has happened, like in 2008 when there was a big crash, people that invested in that decade harvested 80% of their investment in losses, so 800K. And then people who invested maybe in the 90s, closer to the 450 or 400K. And so it depends, but on average, it's about 40% of your investment in losses for a long only a classic direct index, right? And again, it kind of is the same very close percentages that we found in our own research. But with this slide, I'm putting a bit more texture on the nature of these losses. These losses aren't harvested right away. They get harvested over the years, with most of the losses being harvested in the first 5 years. In the first year, you harvest 15%, and then maybe 8%, 5%, and so on. And in the later years, you end up on average harvesting 1.3% of your investment in losses. And that's essentially what to expect. You put $1 million, and the first year you get 150K in losses, and then 80K in losses, and so on, while tracking the index. And then, just basically put some use cases to what am I going to do with these losses. First of all, some basics about losses. Losses only expire when at death, right? They carry it forward for life. So if you harvest more losses than you need 1 year, you can take these losses and carry them over for the next year and the year after and so on until you use them, right? And if you don't use them, you can sort of like allocate $3,000 of those losses to offset ordinary income, right? And another kind of, by the way, huge finding that we have discovered with the audience in general is that there's little awareness that short-term losses can offset long-term gains, and long-term losses can also offset sort of like long-term gains, right? They're interchangeable. And the way it works is first, short-term losses offset short-term gains, and then they offset long-term gains, and vice versa for long-term losses. So that's kind of the basics of cap losses and how they work. Most people use cap losses to cover expensive, events related to maybe diversifying concentrated stocks. Like if you bought Nvidia 5 years ago and now it's a big portion of your portfolio, and you not want to sell it because of the tax hit, well, now you have losses. You can use the losses to offset the sale event from Nvidia, selling your Nvidia stock. Or you're a founder, or you have an exit, or you sell a practice, or maybe you're invested in some hedge funds that are giving you K1 tax forms every year with cap gains. You can use the losses to offset those things. Or selling real estate, right? So those are kind of the most common use cases we hear our customers talk about, how they're using the losses. And zooming out a bit, you may not have these cap gain events, or maybe they're not significant enough. So direct indexing is also useful at retirement from a taxable account, right? Obviously, all of direct indexing is only useful in taxable account. There's the tax sheltered accounts already have preferential treatment there from a tax perspective. And so we kind of did this research ourselves, because we're like, wait a second, not many people know about how beneficial it could be for a customer to sort of like invest in a direct index as opposed to an ETF over the long term, even without these like kind of discrete events of cap gains, right? So let's take this scenario: $1 million portfolio over a 15-year horizon, and the customer is taking out $10,000 a month in withdrawals, right? After 5 years. So they invest in for 5 years, and then after that they're taking out 10K a month, and at a certain tax rate. Actually, if the tax rate was higher, the numbers would look better. So we don't want to increase the tax rate by too much here to bias anything. And so let's take at the bottom, you see the $1 million being invested in year one, and in year 6 and on, you're starting to do this like 10K a month withdrawal, and then after the 15th year, maybe at year 16, you sell everything, right? And so with an ETF, what most people do is, or like today, they invest the $1 million in the ETF for the first 5 years, kind of nothing happens, it's growing, right? And then you start paying taxes as you withdraw down, as you sell down this ETF, right? You're paying a bit of taxes, it's all cumulative here, and then at the end you pay all the taxes owed when you sell the entire portfolio. So that's a simple ETF setup. Here's what happens with a direct index. This is the magic of capital losses, right? In the first 5 years, you're not selling anything, but it's generating these losses that you're accumulating. You're filing your taxes correctly, so you're carrying forward these losses to future years, and then you've accumulated this like bank of capital losses here by year 5, right? And now you're starting to exit the position. You're selling every year slowly, and so when you sell, notice like what you're doing is you're chipping away at the cap losses that you have, right? And so by year 6, 7, so your first tax bill is actually only due in yellow in the direct indexing case at year 13. So this is classic tax deferral, right? In those 7 years where you didn't pay taxes, right? You are yourself compounding, those theoretical tax payment. You're compounding that yourself and growing those assets, as opposed to having paid the IRS early and for the IRS to compound. Obviously they don't compound, but to compound theoretically the assets, right? So that is the case to be made for someone who's doesn't have the cap gains, but can utilize direct indexing, as a core way to invest into retirement without sort of like these like outside cap gains. Although we still believe everyone has these outside cap gains, selling a house, downsizing a house, again, concentrated positions. But even in the worst case where you don't have them, right, this is sort of like the case to be made for investing in a direct index. Obviously at the right price. That's the key thing, right? Like, 5 years ago, it was very expensive and didn't make sense. But now it's different. Okay, so let's maybe dig in a bit on the fees part for the direct index and why the fees matter a lot, and rightfully so, right? Like I myself, when I started this company, before starting it, was pitched direct indexing with a company called Just Invest that Vanguard bought, and there was an advisor was pitching it, and the fees were so high that when I did the math on it, it didn't make sense. I was like, well, hold on, like SPY and even like let's take a Vanguard fund like VOO, right? The S&P 500 or VTI, they're like 3 basis points, and I'm being asked to pay 50 basis points just for the direct index in addition to the advisor fee. So I'm paying now 75 basis points or 78, whatever, 75 over the price of the ETF. The math didn't math for me, right? So this chart basically takes a $1 million portfolio, again, a tax rate of 30%, that's growing, call it 10% a year over 30 years. And it's showing the difference between investing in the ETF and investing in a direct index at different rates, right? So this is when the direct index is 10 basis points more expensive than the ETF. It is more expensive because it's more work, it's more trading, it's like, software, or 23 basis points higher than the ETF, or 40 basis points like what you find on Fidelity today if you go to Fitfolio, or through an advisor, 75 basis points. So you'll notice that each of these charts goes up on like in value, as in you're making sort of like an alpha, or you're getting tax savings, you're investing those tax savings back in the market. So you're beating theoretically the ETF, right, in those first 5 years consistently throughout these things, because all direct indices harvest the most losses on those 5 years, and you're benefiting from compounding those tax savings, right? But slowly, the high fees end up chipping away at that tax benefit that you got. In this wealth advisor case, the high fees end up sort of like chipping away that advantage, such that by year 11 or 12, you're back at the x-axis, and in later years, you actually kind of dip below. So you're like losing value relative to the ETF, right? And similarly with a 40 bips fee, and sort of like the green and orange are the only ones where in the 30-year horizon, you end up like in the positive. But here's kind of the fun fact. Even the blue line touches the x-axis later, but it takes about like 150 to 200 years for that to happen, right? And which, not many people, live that long. So it's probably not a problem worth, digging into now. But the blue line is where we sit at Frec. We are trying to get a product that is so compelling for the customer in terms of additional value that it becomes sort of like a no-brainer for them to use this.
Let's stop here for a minute, Mo, before we move into the next section. Maybe dividing up our Q&A sessions is the way to do this.
Yeah.
I want to spend a little bit more time on just the simple direct indexing product you offer. In a lot of ways, your estimates, your graphs underestimate the value of the losses, because the truth is that most investors don't ever sell their entire investment. And so you're not just deferring, those taxes, they go away completely. If you give these appreciated shares to somebody in a lower tax bracket, like the 0% bracket, or you give them to charity, or you die before they've all been sold and you get the step up in basis, those capital gains are never paid. You never pay taxes on them. And so they can really pan out having these losses long term. Even in retirement, if you've got a bunch of losses to offset gains, you might be selling shares that are only 20% gains to start with. And if you can offset even those with losses, you can really spend a lot of money tax free. And so acquiring capital losses is a wonderful thing. The real value proposition direct indexing is offering is trying to collect more of them than you could get just by tax loss harvesting at the fund level, at the ETF level itself. Have you ever seen anybody try to compare, the amount of losses that one can acquire using direct indexing versus tax loss harvesting, every time there's a bear market at the fund level itself? How many more losses are you able to harvest? Twice as many, or 50% more, or 3 times as many by direct indexing over the long term versus just tax loss harvesting at the ETF level? Has anybody looked at that?
Yeah, we actually did a study. That was one of our first research papers that we published when we first launched Frec, because that was a common question. Like, hey, why can't I do this with an ETF? Like, I'll buy VOO, and then when the market dips, I'll sell it. I'll buy VTI, or I can like automate this through a robo advisor. Like the first iteration of robo advisors that came out, the Betterments and the Fidelity and the Wealthfronts of the world, they did this motion, right? They buy 2 ETFs and they kind of swap between them. It turns out that doing an ETF to ETF tax loss harvesting scheme, even if it was perfect, as in you timed every bottom, you swapped it to like the other ETF, and even if you didn't choose a replacement ETF that was substantially different. If we switch SPY with VOO, which is not recommended from a tax perspective, even if you did that, just to give the full benefit to the strategy, you get half as many losses as you get with a direct index. As in, the direct index harvests twice as much at the stock level losses as an ETF. Why? Because there are days when the ETF is up 0.5%, but underneath the surface, you have a stock that's down 10%. So the ETF could never capture that, right? You could never sell the ETF, right? With a direct index, you sort of like unpack the basket and pick the positions that are actually down, and you can sell those and harvest losses. So you get twice as much. But not only that, you get that at I want to say like a fraction of the fee, because with ETFs, if you have especially if you're using like a robo advisor, right, like a Betterment or a Wealthfront, they're charging you a 25 basis point fee on top of the ETF fee, right? So the ETF fee was 3 to 10 basis points plus 25 basis points. Now you're paying a lot of money for like half the amount of capital losses.
Because the Frec fee replaces your ER for the fund or the ETF, correct? It's not. Yeah. There's no additional fee. There's just the one fee.
It's just the one fee, exactly.
Yeah. Now the whole reason that this has to happen, this direct indexing, is because when laws were put in place for mutual funds are required to pass their gains through to their investors, even if the investors don't sell the fund, but they're not allowed to pass losses through. And that's why, people are required to buy the shares of the stocks themselves to do the direct indexing to get those losses. Do you think that ever might change? That the laws might change and allow mutual funds to do this for us and pass the losses through to us?
I don't think so. I'm not an expert. I'm not a tax expert or sort of like a legal expert, but sort of like ETFs, they're a special vehicle, and the reason they exist is because of a Nixon era law that came about in the 1970s. And what it did is it said, well, there's all of these heartbeat type trades that ETFs can do with market participants. Specify a specific participant called the authorized participants, right? And there's only a few companies that are like authorized participants. And when an ETF needs to rebalance, they go through these authorized participants to be able to rebalance or trade without sort of like passing down these losses. I do think mutual funds and ETFs are so ingrained in our financial sort of like ecosystem today that it's like very difficult, I think, for anything to change. It would be quite a substantial change for that to happen. And similarly, I think the wash sale rules and the tax loss harvesting rules and all of that world is also quite ingrained. Like, people have been doing this since the 80s. Like, again, when I started this company, I did a bunch of research and I talked to all these like very large family offices. We're talking about like $1 billion plus in assets. And these large family offices, they're not buying the ETFs. I was shocked. They don't buy a single ETF. They buy direct indices. They use Northern Trust and all these like very high-end custodians. And they use tax loss harvesting, and they do it at very low fees. And they collect the losses, right? And then they have private investments, right? They have both public and private. And so they use the losses from the public arm of their family office to offset sort of like the gains from the private side of the world, like invest LPs in private equity or in venture. So it's been happening since the 80s or even before that. And, I think there's enough precedence there that it's very difficult for these laws to change. They're quite consequential if they did.
Yeah. So, I mean, the real new thing is that it's being offered to the masses,
That's
people that don't have family office kind of money.
Yeah, exactly. And that's kind of what we're passionate about is how do you bring it down to everyone else? How do you level the playing field?
Yeah. Okay. Well, I mean, the primary, value pitch here is that you're able to save some money in taxes, so your after-tax return is being boosted in reality. But it's important anytime you start talking about investments that you don't let the tax tail wag the investment dog. So perhaps the first thing we ought to be asking here is, how well do you index? Are we actually getting the index return, or are we underperforming the index by more than we're saving in taxes? How well do people end up being able to follow their indices when investing with Frec?
This is a fantastic question, and I think sort of like the way to think about it. There's a bit of math. I want to explain the math because it's not that difficult actually. Some advisors make it sound crazy, but it's easy. So here's kind of the way it works, right? You are trading, right? So when Tesla falls down, you sell it, you buy something else. The correlations there are not perfect, right? So you accumulate what we call tracking error as you're selling and buying different positions as the market moves. Now, on average, the mean or the average, you're expected to track the index with a 0% tracking error. But again, remember, that's a mean, that's an average, right? You have a distribution around it, right? So you have one standard deviation away, which in plain English means you have a 67% chance of being plus or minus 7.77% around the index, and you have an equal chance of being either plus or minus. So let me put that in like practice, again in English is, okay, I buy the S&P 500 direct index on Frec. I have, in 1 year, the S&P does, let's call it 15% in a certain year, right? Now, you're expected to track the index on average, across all the accounts at 0% tracking error. So on average, if I take all the indices, all the performance of all the customers in the S&P 500, they're all going to get, on average, 15%. But there's a distribution, right? And so some of them are going to be 15.77, so they're going to beat the S&P. The tracking error will work in their favor, and others are going to be 15% minus 0.77, right, or 14 point whatever 33%. 3%. And so those are kind of the two extremes. And you have a 67% chance of being, in that range. Of course, there is the 33% chance you're going to be even more of an outlier beyond that. But it's a small chance. And so every year you're running this chance of being either above or below at 0.77%. So 1 year you may be above by 0.33. The other year you may be below by 0.7. And then the following year maybe above by 1%, right? On average, it works out in the long run, but that's sort of like the flexibility that you are giving up in exchange for getting these capital losses to offset your tax bill.
Is it possible to have long-term underperformance? Like for 10 years, if I stayed with Frec for 10 years, is it possible that maybe I ended up, with an annualized return that's 0.5% below the S&P 500?
Every single year?
No, just on average over the 10 years.
But it's certainly possible.
Yeah.
I think the math to be done here is like, okay, well, you've harvested 40% of the losses of your investment over 10 years, right? So let's say you invested $1 million, you harvested 400K, depending on your tax rate, you would have saved like real money of maybe call it like, $150,000, right? That you would have otherwise paid the IRS. If you took that money and put it back in the market, right, then the growth of that additional 150K on top of your $1 million portfolio should make up for any of that like small tracking error that happens.
Yeah. The other question I have about the indexing is, the 500 index is obviously very popular these days, right? Large growth has gone crazy the last decade or so, and so everybody loves, the S&P 500. Long term, I tend to prefer a total market index, a VTI to a VOO, for instance. How much do you think of the popularity that Frec is seeing is due to the fact that a lot of what people are indexing to is the S&P 500? Can you talk about some of the other indices that are offered and the pluses and minuses of using them?
So we offer the VTI index. We have the CRISP indices as well. We have a total U.S. market cap index. We have a value index, a growth index, a large cap CRISP indices as well. I think they're VV and V, if I'm correctly remembering the Vanguard equivalents. But we basically have all the popular Vanguard funds available on Frec today as direct indices, right? One thing, by the way, that is a popular customization, because that's one thing we didn't talk about today, is you can customize your index. And surprisingly, actually, not a very popular feature on Frec. Maybe if I work at Uber, I'm going in and removing Uber from my VTI or whatever to not double dip. and buy as investing my stock. That's a popular reason for people to customize. But sort of like we're trying to see some people who are like underweighting the Mag 7, right? They go in and they say, well, I want the top 7 names to be only 0.75% or something like that of its normal target weight. So I kind of like more overweight, the bottom. I'm personally not a fan of that. I want kind of the free market to work itself out, and I think a market cap weighted index is totally fine. It's a personal opinion. I'm not too worried about concentration, but people with certain biases can now express them in a direct index, whereas like with an ETF, you really don't have that flexibility.
Yeah. Okay, the other, I think, big downside, you've kind of addressed pretty well, fees. Actually, I have one other question on fees. The website says the fees start at 9 basis points. What can they go to?
Yeah, so 9 basis points is it's like per index, it's price per index, right? So it's like the S&P 500 is 9 basis points. I believe the total market cap index is 13 basis points. We have some international indices too, because some people like to construct, like a total world through these indices. So we have a developed and an emerging markets, and I believe those are 19 and 25 bips or something like that. I don't have like you know I think they're in that range. And then the more expensive indices are like the SMH index, for example, the semiconductor index. The ETF is 35 bips, so our direct index is also 35 bips. So the way we think of pricing is like we never want to be 10 bips more expensive than the ETF. Never. We want to be in this blue zone right here. And so any of our indices are going to be priced at 10 or less above the price of the equivalent or the closest ETF to that index.
Okay. The other big question I think people have with direct indexing, besides, is it worth the fees, is unwinding the strategy, right? They change their mind in 5 years and they're like, I don't want to do direct indexing anymore. Now I've been, direct indexing the S&P 500. Now I've got, 400 or 500 shares of stocks in my brokerage account. How do we unwind the strategy? How complicated is it? Do I now end up with 300 legacy investments that I don't actually want to own, that I don't want to sell because their basis is now so low? Can you talk a little bit about, somebody that changes their mind and doesn't want to stick with Frec for the rest of their life?
Great question. I was just clicking around to see if I have that slide available, but maybe I'll just talk through it actually. This was a very common question when direct indexing was offered at this like purple purple zone of 0.75, because people get to this point like, hey, it's not harvesting losses and I'm paying a crazy amount of money for it, get me out of it, right? And so I just want to say that up front, that was the most common reason for people to want to unwind or get out of direct indexing. At low fees it's less of a thing, but happy to also kind of address it as well, because it is possible to get out of it. So it's essentially what you do is you've harvested losses, right? You've harvested a lot of losses. Let's say you haven't used them. You're like, I don't want them anymore. And so what you do is you kind of give them back, right? It's almost like a refund, right? When you sell the direct index, you contribute the losses to sell out. You want to be smart how you do this. You want to sell out the long tail of the direct index. So, because it's a market cap weighted indices, all the gains usually accumulate to the short tail or to the big companies within whatever the index you're in, right? And so what you want to do is you want to use the losses to sell out of everything else. And so instead of you're left with 500 stocks, now you're left with maybe like 20 stocks to manage, which is way more manageable than having this hodgepodge of 500 things to manage, right? And that's kind of one strategy. The other one is, today there's this new type of ETF that's coming out, or not type of ETF, but strategy. It's called a 351 exchange strategy, where you can take stocks and contribute them to an ETF and get back ETF shares. We haven't really looked into that, but we think that's a great way to off ramp from direct indexing into like an ETF. For convenience only. Like, again, there's not going to be, I think, that much of a fee delta between the ETF and the direct index in the long term. I think this will continue to shrink. Eventually, it will cost probably around the same. And so if it's a problem of being bothered by the stocks, and how many there are. There's a collapse button. Just collapse them into a single line item. Not to minimize kind of the issue, but it's nice to have optionality, right? It's nice to be able to say, well, I'm going to donate this particular tax lot to charity because it has the lowest cost basis, the most amount of gains, right? And so there's a lot of nice things you can do when you have this ownership over the stocks, over the direct index. But having said that, if you want to leave, there's ways to do it.
Yeah. Yeah. I imagine if you've chosen to use a total market index, that becomes that much more complicated than if you only own 500 stocks.
Yeah, well, it turns out with a total market cap index, you get, I think, like 96% of the um, total weight of the index by buying, maybe instead of the full 3,000, you buy 1,000 of the 3,000, and you get like vast coverage of the market cap. So you end up tracking it very, very closely with not 3,000, but maybe 1,000 stocks.
Yeah. So maybe not quite as bad as one might imagine getting out of that then.
Yeah, exactly.
Okay. And it's important for people to understand that this is something you do in your taxable account, right? You're not going to use this strategy in your 401k. You're not going to use it in your Roth IRA. This is only your taxable, non-qualified brokerage account where a strategy like this makes sense. Okay. Well, you guys are doing some kind of unique things that allow people to get even more tax losses than they can get from direct indexing. Some of these, 140, 40 funds, et cetera. Can we move into that section of your presentation and talk a little bit about how people can use long, short direct indexing to maybe get even more tax losses they can use?
So, yeah, super excited about this part of the presentation and this product in general. I just want to sort of like start by defining the strategy. It is about, unlike classic direct indexing, where it was just like solely about deferring taxes, this strategy does require the customer to have an opinion on the market while harvesting losses. Now, not something a classic bogglehead loves to hear, but it does require that. And if you are comfortable with that, as in, let's say you work at a big tech company and you have a ton of meta stock. Clearly, you're exposed to too much of the growth factor, right? And so you may want to have a direct index that exposes you to like the value factor or the quality factor to offset that exposure into growth, right? So if you're comfortable with that market opinion, then yes, as a byproduct of that, you get maybe 3 to 10 times as many capital losses as a normal direct index, like way more. And let me get into that for a minute, right? So that the type of factors that are supported on Frec today are growth and quality, growth and value. We're working on quality and momentum and size, but that's sort of like the prerequisite to using this product. And by the way, we curate these factors for you, right? We're like, okay, which factor do you want, growth or value? And each of these factors has something called a pre-tax excess return. So I'll talk about that in a minute. But first, let's talk about the losses, the byproduct. You get a lot more losses. So this is someone. So basically, you can harvest. With a classic long only direct index over the Russell 1000. This is kind of a new study. It has a different beginning and end time. We wanted to capture as many like dips as possible. So this study, I believe, begins in the year 2005. So it captures the 2008 crash. It captures the 2018 dip. It also captures the COVID dip, right? And so with that one, with a classic long only direct index, you've invested $1 million, you got 300K back. But with the long short, you're capturing 120% of your with a 140/40 direct index in losses. So you get $1.2 million back in capital losses versus 300K, right? And for many of us, that's kind of meaningless. Like I'm not going to be able to go to the vending machine and turn that into cash, right? But but if you have the gains, it becomes super super valuable and instantly translates into tax alpha and real tax savings. So just to kind of visualize that, this is what cumulatively you're harvesting losses in the long only, the blue dot here, blue square, up to 30% by year 10. A long short just blows it out of the water, goes up to 120%. And the other kind of common kind of criticism of long only is like, okay, well, in later years, it's only getting me 1.3% a year. But long short keeps on giving. Even after year 10, it continues to give out losses because of that short extension. I can talk about that in a minute. But sort of like after year 10, you're harvesting 11.1% every year of your initial investment versus 1.3% for a long only. So again, more advanced product requires you to have that opinion about the market, that exposure, like value or growth. You have to make that choice. You might be making the wrong choice, by the way, and you might be underperforming the market, right? But you as a customer have to make that choice. But if you do, then it opens up like a ton more in capital losses for you. And it looks just like the long only index, right? This is a Russell 1000 value index. Let's look at like November 13th over here. You can, by the way, go on the demo site, the Frec.com. On the top, there's a demo. You can go into the Russell 1000 long short value index, and you can see the tax alpha. You can also see how it performs against the ETF. I believe tracking error is very low, like over the past couple since we started this strategy, and it harvested $3,800 in just a few months. And it's going to harvest a lot more, probably, based on the historical sims over the next couple of years. You see the factor tilt over here. You see the positions. You see there's shorts and longs, right? And the reason it does that is because to express this like value tilt really, really well, it wants the maximum flexibility. So it may sort of like go long certain things. It will also go short, sort of like other things that are counter to this tilt that you've chosen, right? And you can see the leverage. And by the way, this is only the 140/40. We're talking, the 250/150 is maybe our most advanced one. It's for a customer who wants quite large exposure to that factor tilt. And that 250/150 generates, I want to say, 330% of the investment in losses in 10 years. Okay, so I'm going to quickly kind of go through these for those of us who are curious about the construction of the portfolio. So the way it works is we first buy the long only portfolio. So you bring in $1 million, we buy the index, the Russell 1000. The Russell 1000, by the way, is a large cap, US large cap index. It's not a small cap index. A lot of people confuse the Russell 2000 with the 1000, but the 1000 is kind of a superset of the S&P 500. It's got the S&P 500 plus 500 other companies, ranked by market cap. So you buy the Russell 1000, and then you go long, meaning you borrow to buy an extra 40%, and you go short another 40%. Again, all in service of expressing that factor tilt, right? And I guess you express the factor tilt, and so what does that get you? The shorts. Now you can harvest losses even when the market is going up, because shorts lose value when the market is going up, right? And the other thing is going long is subsidized now. That's kind of a technical detail. If we were just to go long with borrowing against a portfolio, you're paying the full 5 point whatever interest rate, right, to go long, the Fed plus whatever 1% rate. But because you have shorts, technically the way the shorts work is they generate cash, and the cash outputs yield, and the yield offsets the cost of going long. But long story short, it is sort of like a nice complement to the longs in that the financing costs are very subsidized, right? And if you want to look at the after-tax returns, just to compare like a classic direct index versus a 140/40 direct index, it's more than double, right? So again, assuming you have all the capital losses and gains to offset with the capital losses. And so again, this product is not right for everyone, purely from a capital efficiency on taxes, right? If you have high capital gains every single year, let's say you're an investor in these like hedge funds and you get this K1, or you work at a finance company, right? Then these or maybe you're diversifying concentrated positions over 5 years, right? Then definitely it's worth buying the long short index. If you have a one-off, maybe, or a near or future like cap gain, like you're selling a medical practice, you have gains or something like that, right? then you can start with a long short and then deleverage down. You can do that tax efficiently as well. Go from long short to classic direct index. But if you're not sure and you have like some far away in the future cap gain event, then I would say stick to the classic product, the classic long only index. And then you can always like leverage up if you need to in the future, right? You don't need to take on that complexity and cost, because it does cost more to go long short than long only. So those are kind of the three buckets that we think about when we meet customers. I think it's important to touch on pricing a bit, because what's special and unique about Frec, again, just like in the long only world, you can do it yourself. In the long short world, you can also just do it yourself. Don't need that advisor; they're gone. Save those fees. By the way, I have nothing against advisors. I think they're awesome. I just have a problem with them gating access. They're like, oh, I can get you this like cheap margin loan, or I can get you a direct index or a long short only if you sign me up, right? I think their job is way more than just access. Anyway, so for the 140/40 product, it is a fee of 0.5% and the financing cost on the portfolio of 0.5% as well. And that's kind of the long and the short extension. So it is a more expensive product, and it is only worth it, in my opinion, if you believe in these numbers. First of all, there's a tax alpha, right? So essentially, you need the tax alpha. So the ones in bold are the positive numbers. So you add 3.77 plus 0.24, and the ones in gray are kind of the costs, right? And so your after-tax return is kind of just the sum of these numbers, right? The tax alpha is very high because it assumes you have, you're maxing out the cap losses that you're generating. Again, that presumes you have these cap gains, right? And then the pre-tax excess return is that factor tilt, right? We only launch factor options that over the long term beat the benchmark by some positive number, right? Otherwise, it doesn't make sense to factor tilt, right? This is, I believe, the value tilt. I don't know actually. I need to. Yeah, this is the value tilt, 0.24% per year in pre-tax excess return, right? And so you have a 3.77 plus 0.24, and then you have fees, the Frec fee, the management fee. This product is way more complex to run. We have to monitor the margin. There's a lot more like software and complexity that goes into it. So there's a more expensive management fee. There's a financing fee that goes towards financing the longs and the shorts. And then finally, there's more trading that happens, right? You have 180% of the portfolio, right? So 100% the long and then 40 and 40. And so you trade a lot more. And by the way, the fees are only billed on the notional amount of the portfolio. So even if it's a 100K portfolio and it's like 180K technically with the longs and the short, the fees are only billed on the 100K portion of the portfolio, not on the extensions. Okay, that's basically kind of what I had for long short. I have some FAQs, happy to go through them, but they're all, I think, targeted towards the long short product.
Yeah, let's go through those, and then if I've still got some more questions, we'll do those. But let's go through each of those 6 FAQs because I think they're all relevant.
The most common one we get is, can I get a margin call? Well, I think that's why you pay us a fee to reduce the odds of that happening. Of course, we can't say it will never happen because markets can technically go to zero. But we built in quite a bit of excess margin, 45% of the portfolio. So a market dip has to be quite severe for that excess margin to be eaten up. We monitor the portfolio throughout the day, intraday, and we take on some additional steps to make sure that we're mitigating the risk. Number one, we only short the easy to borrow stocks, right? If a stock becomes hard to borrow, we close that position right away and we open up other short to borrow stocks. The second thing is, if you look at our demo account, none of the shorts make up more than 1% of the portfolio. That's by design. We want to keep like risk from a single short sort of like, becoming sort of like limited, right? We don't want one short to really hurt the portfolio if we can avoid that. And then, of course, I mentioned the intraday margin review. So that's a the odds are sort of like are very low. It can happen, and if it does happen, we deal with it. By the way, you don't have to like you're not going to get a call for a margin call. We kind of manage the portfolio ourselves, but the odds are very low given the amount of excess margin that exists. Tracking error is higher, but it's actually kind of different. Remember, like with long only, we said that the mean is 0%, and then you have a plus and minus 0.77% chance. In a factor tilted portfolio, the mean is not zero, it's positive. So you're kind of like the mean, you're expected to make 0.24% above the benchmark, but you have a 67% chance of being 0.24 plus 1.49 or 0.24 minus 1.49, right, percent. So it skews a bit, it moves the mean to the right a little bit, and you have a 67%, one standard deviation chance of being either plus 1.49 or minus 1.49 relative to that pre-tax excess return that we were quoting. So that's kind of the story behind tracking error. And again, like 1 year you can be slightly above, 1 year you can be slightly below, but you can expect on average to be 0.24. Very popular question about transitioning, like, hey, can I use this for like a year and then go to long only, or how does it work? It is very possible to do that. So let's like run through some math. So let's say you ran a 140-40 long short for 1 year. You harvested 21.84% in losses. You realized you don't want the factor tilt, you don't want the excess returns, and also you don't want that many losses, so you want to go back into a long only. You can basically give up or use up 3.8% out of the 28.84 and transition instantly into a long only index. And if you're in it for 3 years, then you can also sort of like you harvest at 46, so it kind of will cost you 12.7% of the 46% to transition into a long only. That's the way to do it instantly. There's a product feature we're building to do it gradually. Let's say you used up all the losses. So now we can do it gradually for you, such that as we generate losses, we shrink down those extensions so that you become eventually land in being a long only. That process, the automated process of doing it tax neutrally, it takes between 6 months and 12 years for every year you've been in the long short strategy. So let's say you've been in it for a year, then it takes 6 months to 1 year to go back into a long only, tax neutrally, assuming you've already used the harvested losses. Can I invest in multiple indices? On Frec, you can. Yes, you can have like a Russell 1000 140-40 index. Alongside it, you can have a small cap Russell 2000. So suddenly you're exposed to the entire like US market, right? Small caps and kind of the Russell 1000 is kind of a mid plus large cap index. And then you have your international indices can sit side by side. You can then go and specialize in like the information technology sector or the semiconductor index, right? There are some nuances, right? You can't short against the box, meaning you don't want to be long and short the same position, right? Let's say you have NVIDIA outside of Frec in your Vanguard account. You want to make sure that you tell us in the setup process of your long short that I am long these positions, do not short them, because you don't want to be short on Frec and long in Vanguard, for instance, right? So there are some of these kind of nuances around it. It's a more advanced product. Can I borrow still against my portfolio? We have a popular feature on Frec where you can borrow against your direct index. In the long only world, you can borrow up to 70% of your portfolio. It's cheap. It's borrowing against a diversified basket, so it's the risk of a margin call is lower. For a long short, we don't let you borrow against a long short portion because we save all of that excess equity to prevent a margin call, and we're not comfortable yet like opening that up. But you can borrow against everything else. So you can borrow against your ETFs if you have them, on your other indices, individual stocks. And then finally, the tax returns are exactly the same as a long only index. We got a summary, short and long term losses that are or gains, right? And you kind of file them. You send them to your CPA or file them yourself. I think I might have touched on this quickly. So we have a line of credit, we have a treasury product, we have self-managed. One thing I want to just quickly point out, because I know we're uh, coming up on time here is the fact that we have a promotion for white coat investors members that you could get 75K managed for free for any direct indexing product, and that does include long short indexing. But it does not cover the financing fees of long short indexing because those are kind of outside of our sort of like purview. They're built by the custodian of the assets. So that's I think that's all I had. So maybe if you have any more questions, then
Sure. I think the big question people have when they hear about this, most people are not managing long short portfolios, right? I think their big question when they hear about this kind of new strategy is how does this blow up? What has to happen for me to really regret doing this? What can go bad? You talked a little bit about margin calls, but when do long short strategies blow up and have problems?
Yeah, it's a great question. I think you can think about it in terms of simply tracking error. Because something blows up, that means it just has a lot of it's like underperforming the market by quite a bit. Again, like these strategies, we talked about a 0.24 plus or minus 1.5% tracking error for the 140/40. The higher leverage ones have an even greater tracking error. They can go up to plus or minus 3% from the index, right? So if the index does 20, you may do whatever its pre-tax excess return plus or minus 3, right? So you could be underperforming quite a bit. But I don't think it has any besides like a huge market dip that causes like a margin call, which we would be managing and like shrinking the extensions if that does happen. Um, there aren't any other kind of major risks. There's maybe one that we're going to talk about soon in a research paper in terms of like an alpha shock. Like let's say you picked the wrong factor. Let's say you picked I don't know, value, and it just happens that in the next decade value like drastically underperforms the market, right? That is sort of like, in my view, that is kind of or like only the value stocks specifically are the ones that like get hit the most with a downturn, right? That's typically where we see some risk. But as a customer, you have the ability to rebalance your portfolio into another factor. It's generally, if you accept these risks, higher tracking error, the potential for a margin call, but like again, excess margin is 45%. So can the market correct like beyond that? Sure, it happened in 2008. But even then, you're not wiped out completely, right? You're kind of, we are shrinking, we're servicing the margin call through the portfolio itself. There aren't any other kind of more meaningful risks than those ones, I would say.
Yeah. So the real question an investor has to ask themselves is it worth taking on, that little bit extra risk? Is it worth paying a little bit more in fees to get more losses? Can you use the losses? Are you about to sell your home that's appreciated dramatically? Or are you going to sell out of your rental property portfolio? Or are you going to sell a practice or a small business or something like that more losses would really be valuable to you? Maybe it's worth some extra fees, some extra risk. That's basically the value proposition being offered, correct?
I would say also like there's a very popular product out there in the market called AQR. It's a hedge fund,
Mm-hmm.
right?
Yep.
And the AQR hedge fund has been in market now for 3 years with this product, and you have to have an advisor to use it, right? First of all, the fees are expensive for all long short products because it's more expensive to offer these to the customer. Um, and then on top of that, having to pay for an advisor, right? So think very carefully, I would say, about, do I need this? Do I believe in this factor tilt? Because you have to get the factor tilt, right? With AQR, it's slightly different because you're basically like trusting them as a hedge fund and their alpha strategy, right? And you're basically, opting in for that alpha strategy, you're believing in it, right? And then also getting the byproduct of that is you get all these tax losses. With Frec and BlackRock, for example, has the same philosophy as us. Their product Aperio, you still need an advisor for them, but it's also factor based, right? Those are kind of the considerations that you need to think about. both from a pre-tax, what do I want that pre-tax excess return? With a hedge, I go with a hedge fund and I'm trusting AQR. The fees are $3 million, by the way, for the more aggressive strategies at AQR. Ours are like 100K to 500K, depending on the leverage level. So we're way lower fee minimums. But yeah, sort of like, do I want the pre-tax? And then also, do I need that many? Do I need like 300% of my portfolio in losses, right? Some people do, some others don't.
Yeah. Very nice. Well, Mo, thank you so much for your time. For those who are interested in learning more about Frec, whether the direct indexing products or some of the newer long short products, you can check that out, whitecoatinvestor.com/Frec. You can also use the URL you see on your screen there, frec.com/referral/whitecoat. They've got this deal available to save you a little bit of fees, kind of an introductory deal that you can check out there for your first $75,000. And we appreciate your time and explaining how this all works to us.
Awesome. Thank you so much. Thank you for having me. It's a pleasure.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.